Well, Wall Street's biggest bull predicting the S&P 500 will jump 16% from today's close by the end of the year. Chris Harvey is the Wells Fargo Securities head of equity strategy. He is with us here. So why are you so bullish then? You're looking for 16% upside from here when there is still so many known unknowns or unknown knowns.
If you look at things, right, there's a narrative and then there's the fundamentals. Credit spreads, 85 basis points over, not very recessionary. If we look at the IPO market, the M&A market, we were worried about that. IPO market is hot. M&A market's beginning to come back. If we talk about the change in regulation, we haven't even seen the benefit in the change in regulation just yet. If we get some sort of trade progress, and we're all talking about China, but when I look at what happened with India, some of the rhetoric coming out of the Indian-U.S. negotiation, that was actually pretty positive, right? That could be the template. And what did Waller say not that long ago? Hey, if we only have 10% tariffs, we can start cutting rates. Now we start cutting rates, that's a whole new ballgame. And if we do have resolution, not resolution, we won't have resolution, but if we do make tangible progress on trade and tariff, you can start looking through that bad news and you'll start looking to 2026, and that's pretty good.
How do you look past, though, the way that investors and or consumers feel when we talk about the soft data?
I discount the soft data heavily, right? I am trying to talk to anybody who will talk to me on jobs, right? We're hearing a lot of noise about jobs, but I can't find the real pain, right? We're talking to economists, we're talking to corporations, we're talking to analysts. You see pockets of it, but there's nothing systemic. And the soft data, it's just not there. We went through the presidential election cycle. Soft data didn't work. The predictive data did work, and that's where we're placing our bets. That's where we're placing most of that focus, and that is supporting the hard data.
My worry about the jobs, though, is that we may not have seen it yet if companies are going through these various mitigation strategies to try to cut costs elsewhere, and that one big way to cut costs, unfortunately, is to cut payroll. And so maybe we just haven't seen that yet. I mean, is that factored into this?
Yeah, that's fair, right? So the comment before was, do tariffs work with a lag? Possibly, right? And the other thing that we talk about is uncertainty, right? And I'll throw out a comment that probably won't make sense at first. If you don't know, you know, right? If we get to the middle of summertime, we still don't know, then you know you have to make those hard choices. You know you have to cut costs. You know that you have to reduce the labor force, and everyone will do it together, and that is the big fear.
Chris, when you look at rates, you talked a little bit about it before, but when you look at the CPI number, the biggest in CPI and PPI are shelter costs.
Right.
So those went up, but gasoline went down, and that dragged down the overall headline number. Where do you see that going? How does shelter costs come in? Because that's the only tailwind for this economy is if the mortgage rates come down.
Right. So mortgage rates can actually come down if you get volatility in the rate market down. The way you get volatility in the rate market down is the Fed starts giving you forward guidance. The Fed starts telling you what we're going to do 3 months, 6 months, 12 months in advance. We may get that, right? And then you can have rates stay where they are. That volatility starts to compress and mortgage rates come down. That would be a real plus. But also what I would add to that is I think we missed a big opportunity. The U.S. administration could have done something on tariffs, not tariffs, on the deficit. They did not. That would have been a home run trade. That would have rallied mortgages. That would have rallied treasuries, mortgages, so on and so forth, made things much more affordable. That was a big missed opportunity.
You were here at the end of March. You were bullish. That proved to be right. How do you wrap your head around, though, the current S&P valuation, which is high by any historical standard?
So in my take, there's a great, you talked about it before, there's a great secular AI trade. And I lived through late 90s, and we went back to late 90s, and we tried to make the comparison. And at the end of the day, it's not a fair comparison. Back then, you had WorldCom, Quest, Global Crossing, Level 3, all super levered companies going to the credit markets, tapping those credit markets, and leveraging up even more to put fiber in the ground. And the philosophy was build it, and they will come. Today, you have some of the best and the brightest, right, spending on CapEx out of their own pocket. And what you have is something more analogous to Wintel, where the infrastructure or the innovation is sitting right on top of the infrastructure and one is feeding the other. Jensen over at NVIDIA, that phrase that he has, we are producing AI factories. We're producing AI plants. It's a good one, and I believe with that, or I believe in that. And so
Chris,
there's still that great secular story.
I hate to cut you off.